For the next hour, you'll be leaving the Show Me state and entering the Show Me the Money state. So stop what you're doing, grab a pen, and get ready to learn. Randy and Jake Floyd of Floyd Financial Group will be your guides for straight talk and honest answers about living the life you deserve in retirement. So prepare to be empowered. Now, here are your Show Me the Money hosts, Randy Floyd, Jake Floyd, and Jeff Shade.
Thanks so much. Good morning and welcome to Show Me the Money, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about current event headlines, also 5 ways to lower your risk in retirement. Then we'll discuss gifting while you're still alive and kicking and why it's hard to have a successful retirement without a plan of record. My name is Jeff Shade. As always, I'm just here to ask the questions, but the words of wisdom and solid advice, they come from Randy and Jake Floyd Financial Group. And I will start with you, Randy. How you doing today?
Doing very well, Jeff. How about you?
I am doing fantastic. Thank you. Now that it's November. Hey, Jake, how's this Saturday finding you?
Going great, Jeff. Thanks for asking.
Certainly welcome, my friend. Hope everybody else having a great weekend. We certainly do appreciate you joining us each and every week right here for Show Me the Money. Let's start off with what's going on in current event headlines, guys. It is November already. Typically, what should we be looking for with the market or expecting in the month of November?
Well, right now I'm expecting many, many gifts to pour into my front door. No,
pretty soon, huh? It's all about receiving, not giving. No, I know what you're saying, yeah.
I've noticed, though, that even before Halloween last week, Christmas was already on TV.
Oh, yeah.
Christmas is big business.
Yeah, Christmas is big business. November is one of those months that can go either way, and I would say we never know who's going to attack who, blow up who. You know, we have all these different elections and things that have been working here. You know, I am still looking for a fairly robust end to the year. You know, AI is right now kind of pulling on the market a little bit. People are questioning several things about, is it way overvalued? The answer to that in the short term is probably yes, way overvalued. But is it going to be here long term? The answer to that is also yes. And so there's a lot of things pulling on November right now.
And there is a lot of news about some new chip manufacturers who've come into the market. What are some of the high-flying chip manufacturers these days that we might want to keep just a little bit of an eye on?
Yeah, Jeff, I think that, not quite a chip manufacturer, but Palantir is one that was in the news last week. And I think that, Palantir does intelligence work and artificial intelligence work for the United States, but also for Israel and other countries. The CEO of Palantir, his name is Alex Karp, and he's been more and more aligned with Trump lately, which is blowing the minds of the Silicon Valley lefties. Right. And so as things are unfolding here, one of the things we saw last week is that Michael Burry, which may or may not ring a bell for some people, Michael Burry is the guy that the movie The Big Short is about. He's the one that predicted the housing crisis, invented a way to short it, and then shorted it, making billions. And so he is now out there shorting Palantir and NVIDIA, which is kind of an interesting thing. Now, he has, full disclosure, pretty much not gotten a single trade right since 2008, if we're going to really call it what it is. Michael Burry has become known as the broken clock, right? He's right twice a day, right? And so I do think it's a sign of some of these companies, because I think personally that Palantir and NVIDIA are two totally different animals, where Palantir is an up-and-comer, and I do think at some point it will be worth what it's trading at today, but I think it's not even close to worth what it's trading at right now. However, it does have a lot of potential, but I think the shorting of Palantir is very much a Michael Burry special. It's his kind of company to short. I think NVIDIA is a very different animal because it's trading at like 27 times forward earnings instead of 300 like Palantir. And it's a much more established company, has way, 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 way more revenue. They're going to end up at something like $200 billion a year in profit, before too long here. So if you do the math on all that, I think NVIDIA is in a different boat. But I do think we are seeing pockets of things that are overvalued. So, Palantir, in my opinion, fits that description. But also some of these quantum computing products that basically have no product, right? These companies that are quantum computing companies without quantum computing, which is a difficult sell, I think. And so they had a huge run up, 400-500% over the last 6 months to about a month ago. And then a month ago, they started coming down, and they're coming down precipitously, as we like to say in the industry. But it's an interesting sign of the times, and we're having some of these growing pains, which I think is actually a good thing, because if Palantir just kept skyrocketing into the stratosphere, there's more of an argument for a top there. And now that we're seeing it, even though it comes through and beats and raises earnings guidance and revenue guidance, it still is coming back to earth because it wasn't big enough for the people who were really, there was a bunch of articles before the earnings came out saying Palantir could rally 20% on the back of this week's earnings and da-da-da-da-da-da-da, So a lot of people ask me, I get asked all the time, is the market overvalued? Are we at the top? Is it still okay to invest here? And I think I would answer that by saying it depends on where we're investing. But I do think that seeing some of these high flyers have a couple of notches taken out is a good thing. And some of them we may even want to buy up depending on how far they come down. If they come back down into the realm of pseudo-reality, then we might be a buyer of some of these companies. Because I do think Palantir probably continues to go up long term. It's just we don't want to pay $200,000 for a Ford F-150 pickup, if that makes sense.
Right. Well, it reminds me of the .com era when people were jumping on the bandwagon with anything that had .com on the end of it. And it may be the same thing with something like Palantir. There's a lot of hype about this, but right now there really isn't much behind that. Do you think the markets are navigating on what I'll call soft signals? Because really there's no official GDP or employment reports because of the shutdown.
Well, I don't know how much faith I've ever had in those things anyway.
Yeah.
I mean, I guess it's one of those things where even if you have an inaccurate measurement, as long as you do the inaccurate measurement the same way, the same time, you do get a track record, right?
Yeah, but now we're changing it all. So, even when the numbers come back, I don't know how much you'll be able to trust them after Trump had to fire some people and everything.
Yeah.
I think it will take a little bit of time before people really start taking those numbers to the bank again.
Yeah, I think a couple things, too, that I'd like to point out here is it seems to be more prevalent today than ever that companies, even though they come in and they beat earnings and they forecast higher earnings and better sales the next quarter, many times they're down after they report earnings, which is kind of interesting and an interesting phenomenon to me. Again,
it's just all priced in.
Yeah,
I guess they're running it up ahead of time, right?
I guess that's what they're saying, is that they've just priced it all in. But, I would point out one thing. I think during the .com bubble, the S&P 500 was trading at like 49 times earnings, and today it's about, I think, 23 or something like that is about where we're hanging out right now. So people say, well, this is like the .com bubble. I don't think so. And these companies do, a lot of them, NVIDIA, they have real earnings, where back then there really weren't that many real earnings.
Talking with Randy and Jake Floyd Financial Group, our program called Show Me the Money. Our phone number, that one, 417-889-7233. If you're not sure your portfolio is positioned for times like these, you can call 417-889-7233. Set yourself up with an appointment. It's just a casual conversation, actually, with Randy or Jake here at Floyd Financial Group, and talk about your journey towards a confident retirement. No cost, no obligation, and certainly no judgment. Will meet you where you are. Let's talk about manufacturing, sending some mixed signals, guys. Manufacturing is a telling sneak peek into whether the real economy is cooling or holding up.
Yeah, I think, the manufacturing side of things, we are seeing things come back to the U.S., but I think it's too early to really tell what's happening. And then here we are, everybody's asking the question, well, is AI now already creating these layoffs that we're seeing? Or is it simply the fact that during COVID, we had these companies overhiring, especially a lot of the technology companies, and they've had to let people go. And now with the addition of AI, I think it's even exacerbated that situation.
Yes, is the answer to that. All of it. I think all that's true. I think some of it is AI. I mean, we're seeing in real time even companies that you would not expect to have layoffs due to AI are having them. But we are seeing a lot of the overhiring, the protectionism of employees through COVID and the short thereafter. Finally they're cutting away some of the fat there. Too many people talking around the water cooler 8 hours a day, not doing anything. They're trimming that off. And so I think it's all those things you just said.
We haven't talked in a little while about tariffs and the trade war. What's going on there? Any movement in that front?
Well, it's hard to say because you get so much conflicting information, and then everybody has an opinion, right? So
right.
I think there are probably some positive moves there. I think we got some relief for farmers with the soybean deal. I think that the rare earth mineral thing, I think China probably saw that, there's other places we'll get this stuff, and if they jack it up too much and mess around too much, we'll just figure out ways around them. So,
I think the other question mark is, are the courts going to try to jam up Trump in collecting these tariffs and that kind of thing, because we've already been collecting them, but if he has to pay them back, that could be a big issue. Bessent, Scott Bessent has said that he has lots of options to use on tariffs if it loses the Supreme Court case. We'll just have to see what happens there. But I think the big elephant in the room is China, and I think that Trump is trying to find his way into a good China deal. And I think that that's going to be really important looking forward. And when we say a good China deal, that doesn't necessarily mean we just need to maximize tariffs. What it means is we need to have a good China deal that puts us in the driver's seat of the world while collecting some money there, while maintaining dominance over China and not allowing them to get the upper hand on us. All of that together. And I think that that's easier said than done. But I think Trump, if anybody can do it, I do think Trump can do it. I think he's the kind of guy that could get a deal like that done and across the finish line in a way that maybe no other president has ever been able to do. There's some things I think some presidents have done better than him, but I think it's very hard to point the finger at a president that's done better on trade and negotiating around these really complex, delicate topics.
Randy and Jake, let's shift the conversation to interest rate reductions. Of course, we've had a couple of those already. I understand that there's a little discontent in Fed Chair Powell's camp. What's going on there?
Yeah, there's 3 or 4 of the Fed bank presidents that are talking about the fact that they feel like it's not time to cut again. There's a lot of people. I think it was Monday of this past week. There's a guy by the name of Mohamed El-Erian who runs one of the largest investment companies in the world. Allianz also has a company called PIMCO involved there, which is the Pacific Income Management Company, which is one of the largest bond management companies on the planet. So, if not the largest. And, he's saying that Jerome should have started cutting in June, and he should be cutting right now and maybe even 2 more times before year end. And then there are these that say, no, we think that inflation is too hot at 2.89, whatever it actually is. And of course, there's the argument that lowering interest rates will make business go harder and faster and create inflation. Now, we know that that's not always true, because if we look back over our shoulder, we saw that we had 0 interest rates under Bernanke, and looking forward for a long time there, while he was pumping money into the system. So I think the idea here is we got to get productivity up. So if we get productivity up and we lower the bar for companies to borrow money, small companies to come out and be competitive, I think we can up production. And he even said this, that he does think through AI and some lowering of interest rates that productivity will increase in the country, and productivity will drive inflation down. So I think that there's some confusion maybe on their part there, that lower interest rates directly is higher inflation. I just don't believe that that's true.
So if I'm hearing you correctly, Randy, we cannot count on another interest rate reduction this year.
Well, we can't count on it, but I would still say it might happen.
So right now, the FedWatch tool out there shows a 68% chance of another rate cut this year. But then it shows that it's going to stay still for the next 2 meetings, followed by a cut in April, staying in June, followed by another cut in July, and then staying the same all the way through the middle of 27. So that would put us at 3 to 3.25 on the Fed funds rate. Probably brings us into maybe a 5.5% or so 30-year mortgage, give or take. And so I would say that there's some likelihood of that happening. I think that the Fed will not hesitate to start cutting much more aggressively, though, if the jobs market really starts to become problematic and we start seeing unemployment ticking up. They're going to panic cut. And so I'm not sure that any of these projections really matter. And again, we're going to have in July, right, we're going to have Trump's new pick, whoever that is, and he is going to do whatever Trump says to do. And Trump has said repeatedly that he thinks that interest rates should be 2% or 1% or even less potentially. So we'll see how much there was negotiating going on there versus how much he actually thinks they should be that low. Again, I think you can make the case for them being that low given our debt and our deficit spending, right? Maybe it creates some inflation, but I'll take an extra 2% inflation to reduce our spending on our debt service by $1 trillion a year. I mean, mean, that's a good trade. And I think Trump, that's his main thing that he's concerned about. And very few people understand debt like Donald Trump. He's been
That's true.
He's built his empire off of other people's money. So
Yeah.
he understands that. And I think that, again, I think we're in pretty good hands looking forward for the next couple of years here. And it's going to be a wild couple of years probably, but I think we're going to be in good shape.
Talking with Randy and Jake Floyd, Floyd Financial Group, about current events. 417-889-7233 is our telephone number. If you're not sure your portfolio is built for times like these, give us a call and set up your casual conversation with Randy and Jake here at Floyd Financial Group so you can talk about any adjustments that your portfolio might need. 417-889-7233. No cost, no obligation, and no judgment. We'll meet you where you are. Randy and Jake, time for a break here on Show Me the Money. When we come back, we'll be talking about 5 ways to lower your risk in retirement when our program continues right here on 104.1 FM KSGF, where Springfield comes to talk.
Ready for another helping of some more real money talk? Thought so. Now, here's another serving of Show Me the Money with your hosts, Randy and Jake Floyd, with Jeff Shade.
Welcome back, everybody. This is Randy and Jake. You're listening to Show Me the Money. And in this segment, we're going to be talking about 5 ways to lower investment risk in retirement.
And Randy, you've said before that if you're losing sleep at night worrying about your investments, it might be time to rethink things. Why is risk management so critical in retirement?
Well, number one, if you're married, it keeps your wife happy.
Right. Different risk capacities or tolerances, I should say there.
Or it could be your husband, But
yeah, sure.
We have to remember the guy that needed a brain transplant, right? And he wanted to know why the men's brains were so much more expensive than the women's brains. And the guy said, well, that's obvious. It's because the men's brains have never been used.
Low mileage.
So anyway, not only that, everybody wants to retire and not look back over their shoulder, and you just need a plan that's going to work in all kinds of financial weather as well, depending on if interest rates are high, interest rates are low. We have this old saying, don't fight the Fed. So if the Fed's raising interest rates, it's generally not good for stocks. If he's lowering interest rates, it's generally good for stocks, and we have to look at what the current rate is, whether a CD makes sense or whether bonds make sense, so there's just a whole lot of things going on out there, and you just need to have something that's diverse, that's thought about and reviewed all the time to make the correct changes.
And Randy, I touched on it a little bit. I want you to explain this again. The difference between risk tolerance and risk capacity. They're actually 2 different things. I think risk tolerance is more emotional, right?
Yeah, for sure. I mean, the capacity to take risk is basically, we're going to look at somebody and say, okay, here's what they've saved, here's what their other income sources may be, whether it's just Social Security or maybe it's a pension plan. And then they've designed what they want their life to look like in retirement. And we say, okay, based on what you're telling us, we got to squeeze every dime out of this, or we can go ultra conservative because you're not going to spend the money. So that's the capacity thing. The risk tolerance, on the other hand, is how much volatility can one or is one willing to take based on what markets do as they change.
All right, Randy, let's talk about the myth of the perfect investment. You make the point that there's no such thing as a perfect investment, one that gives you growth, principal protection, and total liquidity all at once. Why is that combination so darn hard to find?
Well, the deal is, Jeff, depending on what time frame we're living in, I've often said if you were in the vinyl record business in the 50s and 60s, you were in a great business. If you're in that business today, unless it's something that's nostalgic, you're out of business, right? So,
yeah.
And it's the same way as we go through retirement, especially today. We have people that maybe retired 25 or 30 years. A whole lot changes. In fact, if you think back 30 years ago in 1995, the things we were doing compared to what we're doing today, it's a whole different ballgame. And your investments and the viability of investments and companies changes along the way. Not to mention, as I said earlier, we got to look at all the interest rates and, who's blowing up who, and our economy's growing, are they contracting, are we in a cyclical bull or bear market? So there's just a lot of things to consider and things that change all the time. So there's no perfect investment because nothing really stays the same.
Right. And, there are several things that money can do for you. It can grow. It can be safe. It can be good for investments. And we can give you maybe 2 or 3 of those things. But as you said, Randy, it's very hard to find an investment. I think, would you say that it is impossible to find an investment that does everything that you want it to do?
Absolutely. Because we're always looking for what? We want growth. We want protection when things are not so good, right? And we need liquidity. Those are the three things that we need. And sometimes when we're looking to shore up an investment and make sure that it's going to be stable, we have to commit money for a little bit of time. The bond market is that way. We commit money for time to earn a good interest rate, maybe better than the dividend that we can earn somewhere else. Like if you look at the overall dividend of the S&P 500, it's probably somewhere around 1.2, 1.3%. There are stocks out there that'll pay more than that. I was looking at, Chevron yesterday is paying a 4.37% dividend where they are currently. But again, those things are only temporary and those things will change. So it's always a moving target. We've always got to be looking at, where do we go next with this thing?
Randy, let's go through the 5 strategies that you mentioned here, starting with CDs. And, they do have some higher interest rates now. And again, what's the real benefit and limitation of using CDs for protection and risk tolerance?
Yeah, so of course the benefit of a CD is that, it's generally considered to be a safe investment, right? So unless the bank folds or something like that, and then you got the FDIC behind that, but it's considered safe. It's going to pay you an interest generally at the end. You don't normally get CDs that pay you monthly, which is kind of a downside to those. And also, if we look back over our shoulder the last 10 or 15 years, the interest rates were pretty low, unless you look at the last, starting in 2022 when Jerome Powell started to raise interest rates, we saw CDs go from 1% to 5.25%. Now with rates coming back down and Jerome ticking it down the last couple of times here, we're probably sitting at 4% CDs. Money market accounts are right along there with those. And, they're probably hanging out at 3.5 or so now, where before they were at 0.2, and things like that. So CDs can be great. They're safe. And when interest rates are high, they're not a bad place for people to go. But long term, they are safe, yes, but they're not going to really promote growth like most people need.
Let's talk about bonds and bond funds as it relates to this conversation about controlling risk in retirement. What's the difference between owning bonds and owning a bond fund? And why is that distinction so important, Randy?
Yeah, for sure. So when you own a bond, you own either a treasury or maybe a municipal bond or a corporate type bond. So a corporation, and you may remember this, Jeff, you're a car guy, way back whenever model changeover came in, which was somewhere around July, they would shut the auto plants down, and all during August, they would do this model changeover, and then in September, they would start producing the new model cars.
Right.
That's the way it used to work, all the time. Of course, now they introduce cars all during the year. You never know when it's going to happen, right? But what these companies would do, Ford and GM, they would issue a short-term bond, and they would issue that bond to appropriate funds to do the model changeover and start to produce the new models. And when they started making their profit from that, they paid the bond off. So owning a bond where you have one company maybe that's going to be paying you back for that, it's important that they have good credit, right? And that we know that they're going to be able to pay us back. Whereas owning a bond fund, it kind of reduces the risk a little bit. It may be that Ford and GM are in there and many other companies inside a bond fund, but they are going to have different ratings in there. The bonds get rated from AAA down to basically, call it an F. There's no F out there, but it's the same thing. It's just, good to bad. And inside a bond fund, though, you're going to have a mixture of bonds. And in some cases, like if you look at BND, the investment grade bond fund that Vanguard produces, there's like 17,000 bonds inside that fund. Well, if you and I go out and we invest, $10,000 into 17,000 bonds, we don't have a lot of risk there if one of those fails. So the bond fund is a little less risky, a little less volatile, and easier to sell, generally speaking, than a traditional bond.
Randy, let's talk about fixed annuities. You've called them similar to CDs, but from an insurance company. How do they work in lowering risk?
Yeah, so basically, there's a couple of differences between banks and insurance companies. One of the things that happened when Jerome Powell started raising interest rates, we had some banks around the country that got squeezed. Why? Because they had bought 10-year treasury bills and things like that and leveraged those with the federal government to borrow money. Well, when they did that and their consumers came back and said, hey, I'd kind of like to have all my money now that interest rates are higher and you're paying me 1%. I'd like to go over and get some of this 5% money. Well, the banks had to go out and sell those underlying assets. And here's what happens. When interest rates are spiking, bonds are worth less. When they're falling, when interest rates are falling, bonds that you own currently become worth more. So let's talk about how an insurance company handles bonds. They buy them and they know they're going to hold those bonds till maturity. they're never going to bail out early. They're never going to sell those things at a loss. They're going to make sure that they hold them, and that's just built into their whole investment strategy. So therefore, we really have a pretty safe investment with a lot of bonds spreading risk over many thousands of bonds in many cases to mitigate risk. And the fixed annuities, therefore, can set a long-term fixed interest rate. Now, the challenge is when interest rates change really quickly, CDs tend to move faster on the uptick and the downtick, whereas the annuities tend to lag on both sides. But that can be a good or a bad thing, just depending on where we go in. So fixed annuities are more stable than just buying a CD that's has an underlying bond asset underneath it from a bank. So also with the fixed annuities, whether it's fixed or fixed index annuities, we also have the availability to defer our gain, whereas with a CD, every time we make our interest, we get a 1099 and we have to pay tax current on that. The 1035 exchange allows us to kick those taxes down the road, reposition that money into a better spot with a higher interest rate. And it gives us some liquidity along the way. Most of the fixed annuities today will give us a 10% free withdrawal per year.
5 ways to lower your risk in retirement. That's what we're talking about with Randy Floyd here at Floyd Financial Group. And the 5th one I'm going to talk about here is cash value life insurance. Now, that's not something I think most people think of as a risk management tool. How can that play a role?
Yeah, so today there was only one type of cash value life insurance, and that was something that was variable and tied to the market. Today we have indexed universal life, which basically is tied to the market, but has a stabilizing effect because it's a fixed product, like a fixed annuity, where you don't lose money when markets go down, but you're able to gain when markets go up. Now, a lot of people say, well, now, that sounds too good to be true. How does that work? I mean, basically what happens with cash value life insurance is the insurance company takes your premium in, they take a little extra and invest it either in the market or through an indexing process, through a fixed index type setup, and you can accumulate cash. So anything over and above what your cost of insurance is invested and earns an investment return. And yes, over time you can build a large cash value in there, and you could even set up potentially a long-term income that would come out of there tax-free, because you're actually getting return of premium in many cases, but also you're going to take a loan against the cash value of the policy and not have to pay taxes therefore. So that's one way to stabilize your retirement a little bit and get some tax-free income.
Randy, as we wrap up this segment here, what's your best advice for someone nearing retirement who's worried about taking on too much risk?
Yeah, so I think the number one thing is let's sit down and talk about it. We need to look at what your options are. Look at what the person's, again, risk tolerance is versus what their risk capacity might be, and then figure out something that makes them feel good. Because at the end of the day, we are human and we have emotions, right? And so one of the things that we talk about in the market many times is what is the public sentiment? How do people feel? Because when people feel good, they do differently than when they feel bad. And so our goal here at Floyd Financial Group is to set up a plan that's going to work through all types of financial weather. And it's just important that we have that conversation and help people to realize where they live on the risk tolerance scale for their long-term comfort during retirement.
Randy, I'm sure that based on our conversation this morning that our listeners here may have some questions. If that is you, you're not sure you're taking the proper amount of risk, or you want to find some alternatives to dial down your risk, we certainly would love to help you out with that. Call us here at Floyd Financial Group, 417-889-7233. You go ahead and make that call this weekend if you want. Leave your name, telephone number. Ashley will return the call during the week and set up this casual conversation with Randy or Jake here at Floyd Financial Group. Now remember, it's not going to cost you a dime. It is totally complimentary, just a casual conversation. 417-889-7233. Go ahead and make that call. We'd love to meet you. You can also find out more about us online at floydfinancialgroup.com. Randy and Jake, let's take a break. When we come back here, we're going to be talking about gifting while you're still alive and kicking when our program continues here on 104.1 FM KSGF, where Springfield comes to talk.
Ready to climb a mountain of financial know-how? Good, because it's time for more Show Me the Money with your financial Sherpas, Randy and Jake Floyd.
Welcome back, everybody. This is Randy and Jake. You're listening to Show Me the Money. And in this segment, we're going to be talking about why would we gift or would we gift our money while we're alive and kicking?
That's right. Why wait until you're gone to help the people and causes you love when you can enjoy seeing your generosity at work right now? Randy, most people think of gifting as something that happens after they've gone, part of their estate plan. Why do you encourage people to give while they're still alive and kicking?
Well, I think it's nice to see what people can do and how it makes people feel and what they get to do it while you're alive. I mean, it's one thing to leave it when you're dead, but you don't get to see any of the fruits of your labor or the gifting that you've done. And I think that's pretty important. I like to see the people that I love and gift things to enjoy it and be happy.
Well, and sometimes, we see this a lot where people will die when they're 93, 95 years old, and their adult children are 70 before they get to see the money.
Exactly.
And they've already either made it or lost it or whatever by that point, right? So I think being able to have some of that money as adult children, Dad, I hope you're listening here. While you're 40 or 41 to be specific,
sure,
like me, I think there's some things to be said for that, especially I'm only kidding with my dad here. I hope people can understand.
Well, I am
that.
your
But
gift,
I think also
Jake.
that
I am
he's the gift. All right.
That's right. Randy is your gift.
But there are a lot of people that are 40 or 45 or 50 years old that could really use a little help from mom and dad. And rather than waiting until they're 90 to give it, it can make sense to help them out a little bit as we go. There's just some things that we need to be aware of that we're going to talk about here, such as gift tax laws and how all that works, just to make sure we don't make any mistakes.
Well, I don't mean to be crass here, but it's always better to gift with a warm hand than a cold one. Well, you've still got some circulation going on there. Anyway, as you said, let's talk about the tax rules around gifting. How much can someone gift or give without triggering a taxable gift issue?
So for sure, this number changes just about every year. I can remember back when it was $4,000. Of course, now in 2025, it's $19,000 per person, or $38,000 that would be for a married couple that you can give to anybody, a rake stranger or your kids. It doesn't matter, without having to file a gift tax return. Now, a lot of people get confused on this, okay? So a gift tax return doesn't necessarily mean anybody's paying a tax right now. The federal government says, hey, each of us can give away $13.99 million right now in 2025 over our lifetime and not have to pay any gift taxes. So most people aren't going to be able to do that. But what is this $19,000 rule? It just basically says if you breach the $19,000, we want you to file a gift tax return so that we can keep track, being the federal government, of how much you've given away over your lifetime against your lifetime exclusion of $13.99 million. Like I said, for most people, this is not a major issue, but it is something that people need to know because they have to file that tax form 709 showing and recording the gift for the IRS.
Okay, so to be clear, Randy, and to make me understand it as well as our listeners, you can give the $19,000 or the $38,000 for a married couple. You can do that on an annual basis without filing that Form 709. But if you do give more than that, then you have to file the 709. It doesn't necessarily mean that you're going to be paying gift tax, but it does go against your almost $14 million exemption for your entire lifetime. Is that about how that works, Randy?
That is right. Now, let's be clear on a couple of things. If you're taking it out of an IRA, yes, you will pay the taxes before you send them the $19,000. If you take it out of a brokerage account, yes, you will be responsible for the taxes after you've given that money and you get the $10.99 at the end of the year. So I want to be clear on that, but there's no additional tax. There's no gift tax unless you breach that $13.99 million.
Okay, so Randy, what exactly qualifies as a quote-unquote gift in the IRS's eyes?
Yeah, so basically that's anything that you give that you don't get something of equal value in return for. So a lot of people say, hey, well, can I sell my $3 million farm to my son for $100,000? Oh, I guess you could, but that's still going to be a $2.9 million gift.
Yeah.
That's just how it's going to work out. So there's no big, yay, we had a win here by gifting necessarily, except for the fact that you get to see that person enjoy it.
All right. Well, timing seems to be pretty important here. When might it make sense to start making these gifts in terms of your lifetime?
Well, with the passing of the big beautiful bill, it put some things in place where a lot of these things that were going to go away this year, we're going to sunset in 2025, did not. So it's still tax advantaged right now for giving these gifts. Now, the tax cuts are supposed to be permanent now. Of course, that is until Congress decides they're not. So other than that, if you've got money that you want to give that's after tax dollars, that's fine. But again, if you're looking at retirement accounts, you need to be careful there. Be sure you don't hurt yourself by going into another tax bracket or something like that. Also, depending on what your income is and where you take it from and what the dividend payouts are and everything, it could affect your Social Security taxes. And then, of course, if you're giving away a big gift, there's this thing called IRMA, which basically says, hey, if you realize an income as a married couple of around $205,000 because you've made a big gift or whatever your regular income is, if all those things added up, you could pay more for your Part B, as in boy, Medicare.
Randy, a lot of people might think of gifting appreciated assets. I mean, like a house or stocks. Are there any pitfalls that we should watch out for there?
Yeah, you're just saddling your beneficiaries with a debt they're going to have to pay if they ever liquidate that asset. It's much better to pass assets like that at death. So let's say it's a farm.
Right.
And let's say you paid a couple $100,000 for it today. It's worth $600,000. If you give it to your kids now, they assume your cost basis of $200. If they sell it at $600, they owe capital gains on the $400,000 difference. If you pass it as a result of your death, they get what's called a step up in basis to the fair market value as of the date of death. If they sold it at the $600,000, they would owe no taxes.
All right, so that's something to consider if it is something like a house, the step-up in basis. I've heard that occasionally that's on the chopping block. Do you think that there is going to be any truth to that going away sometime in the near future?
So, President Biden wanted to put that on the chopping block for sure. I don't think that you're going to see that go on the chopping block under this administration, never, for sure. But, who knows what's going to happen in the future, but it could be that would be a thing.
That could be potentially on the chopping block for Social Security to pay for things, But short of that conversation, I think the next 4 or 5 years we probably won't be talking about that. And it may never be on the chopping block, right? I think one of the things, and again, this is a little bit off topic, but one of the only reasons it pays to be a cattle farmer among other types of farmers in the United States is either some of these different crops and things receive government subsidies, but one of the main things is that you buy this land, you hold it your whole lifetime, and you pass it to your kids with no taxes, and they don't have to pay capital gains tax on it. It's one of the biggest things that makes it worth it. I think if you get rid of the long-term capital gains tax or the step up in basis or both, I think a lot of farmers will be like, I ain't doing this anymore.
Yeah.
And so I think while that's a little bit of a couple of jumps away, I think they're going to have a big fight if they try to get rid of step up in basis.
Right. And the other thing that should be pointed out here is it's the same way if you have stock that you've owned for a long time and it's highly appreciated. We still get step up in basis on that if they take it in kind upon your death.
And I think that's probably what's more under attack than the land. And they may even separate those two things in the event that they do try to attack it at some point. But again, that's not even on the docket at this point. So I don't want to get people afraid of that when it's not even on the table. So,
Randy, let's walk through a few smart ways to gift. What are some of your favorite examples or strategies?
For me, I just don't do it. No, I'm just kidding.
I've always liked cash personally.
Yeah.
Sure. Here's some cash. That's always a good way to do it. But I mean, let's say that somebody needs an education. I mean, I've got a grandchild who's 3 going on 4, and, we're funding some education through a 529 college savings plan. What do you think about that?
So as a tax vehicle, I think it's a great thing. From an investment vehicle, I've never seen one of those that really worked out that well. But again, if you're looking to fund education for your grandkids or whatever, or even your kids, it's a good way to get some tax help at the state level. And then down the road, they will get to withdraw all of those funds out as long as they spend it on qualified education expense. All the growth and everything comes out tax-free.
Sometimes what I like to do, Jeff, is set aside, instead of doing the 529 plan, which has quite a lot of restrictions. I don't think there's really anything wrong with the 529 plan. You can have low-cost investments in there and that kind of thing. In the state of Missouri, a lot of the expense is limited to the state tax, and that kind of thing.
Right.
So it's not as big a benefit. However, if we just set that money aside instead of doing a 529 plan, we just open up a separate account for after-tax dollars.
Okay.
That allows you a lot more freedom. Let's say that this kid becomes a genius, right? And he's got a very high IQ, he or she, and he ends up, getting scholarships, right? You may not want to punish them by not giving them the money if they get scholarships, right? But if you have that money in a side account, maybe you help them pay the rent in an off-campus apartment, or maybe you get them a car, or maybe even at some point you use it as a down payment on a house. I will say that 529 plans specifically tend to be very restrictive, and I can think of a couple of clients that I have that have several $100,000 in 529 plans that they really can't get out of because their kids got scholarships and they didn't have anything to spend the money on.
Well, let's say, in my case, the kid already has a 529 college savings plan. What could we do to undo that, or can it be undone?
There's really not a lot you can do to undo it. There are other expenses that you can use related to education and things like that. But I would just say that, again, I want to be clear. 529s are not bad. They're just a little inflexible for my taste. I'm a control freak, and the guy sitting next to me here is also a control freak,
now,
I can tell you. And so I don't like the idea that if things don't go according exactly to plan, that I might not be able to get that money out in the manner that I would prefer to get it out. Again, there's nothing wrong with 529 plans. They do have great investment options inside of them. I did them for Trevor, for my son, for his private school, where it helped save us on the Missouri state taxes, so you can do that. There's a lot of different things you can do with it. So again, I'm not in any way saying they're bad. I'm just saying I prefer a little more flexibility when it comes to college savings, especially because grandparents and parents that are smart enough to save for their kids' college tend to produce offspring that are very intelligent, and they have high likelihoods of getting scholarships and things like that. So that's my 2 cents on it.
Well, I think that's very valuable there. He's only 3.5, but he has shown some proclivity to, playing golf and basketball and baseball and all sorts of things, too. And he's a smart kid, too. He's been the last week going around chanting, "Let's go Dodgers, let's go Dodgers." He watched that World Series.
Yep.
Mookie Betts is a favorite player. But anyway, he's a bright young man. Let's wrap up on the emotional side here. Randy, what do you tell your clients about gifting while they're still around to see the impact on the emotional side of things?
Yeah, I tell them, we always have to take things in stride, right? So if they have the extra money and they want to do some gifting now, if we're sure they're not going to need it for long-term care, if we know that they're not going to need it to hedge inflation in the future, and they want to do some gifting now, by all means. But, we got to be careful, because all of a sudden if we say, well, I really love my only grandchild and I want to give them $100,000, and let's say I've even still got $500,000 in my retirement accounts, when you start to think about that, if something happens where you need long-term care, or if you just have a lot of health problems, we know that people on average between 65 and death, a married couple is going to spend around $300,000, they say, on long-term care and medical expense. We have to be careful there. But definitely, and if it's something they want to do, I want to talk to people about it, and I want them to do that and make them happy, right? I want them to do what they want to do, but I also want to do it knowing that we're not going to, and this is horrible, throw out the baby with the bathwater, right? Mm-hmm. That we aren't going to create a situation down the road that's going to really come back to bite us.
417-889-7233 is our telephone number. Holidays are coming up. You're wondering about gifting strategies here that you can see while you're still alive. 417-889-7233 is our telephone number, talking about gifting strategies that you can use while you're still alive and see the benefit of that. If you would like some more information, you want to have a discussion about that, give us a call here at Floyd Financial Group. We would love to help you out with that. Once again, it's 417-889-7233. You can also find out more about us online at floydfinancialgroup.com. Randy and Jake, let's take a break. When we come back, we'll wrap it all up here on Show Me the Money by talking about why it's hard to have a successful retirement without a plan. When our program continues here on 104.1 FM KSGF, where Springfield comes to talk.
People of the Ozarks, step away from the fishing pole and prepare to be shown the money, because we're back with more straight talk and honest answers with Randy Floyd, Jake Floyd, and Jeff Shea.
Welcome back, everybody. This is Randy and Jake. You're listening to Show Me the Money, and in this segment, we're going to be talking about it's hard to have a successful retirement plan without a plan.
That's right. You know, it used to be, Randy, that you could retire with a pension, Social Security, little savings, and you would be just fine. But these days, things have changed a little bit. So let's talk about that plan and why it is so important. You say it's almost impossible to have a successful retirement without a plan of record. What do you mean by that?
Well, here's the thing. If you're going to take a trip down the road, if you get on the right road and it's only a straight line to your destination, that's one thing.
Yeah.
But if you're going to have to take some turns and make some adjustments along the way, you better have a plan and have thought about that and have a map, if you will, that's going to lead you to where you want to go over the long haul.
That's right. A plan of record is your roadmap, so to speak. Tells you where your income is going to come from and how your taxes will affect you, how to handle healthcare costs, and how to make sure that your money lasts. Investments aren't the same as a plan, though, Randy. So what are some of the key risks that you see people running into when they don't have a plan of record?
Yeah, so number one, everybody needs income monthly, right? I mean, my bills come once a month. I don't know about yours, but it seems like most all that stuff happens. And of course, I have to eat day to day, right?
Yeah.
So income risk is probably the biggest one. Knowing that our money's going to last, we don't have to look over our shoulder and wonder when it is we're going to be, needing SNAP and EBT, right? And that sort of thing. So
Yeah.
Number two, tax risk. We don't want to pay any more taxes than we need to. It was kind of interesting. I had this conversation come up yesterday. People said, well, if I start taking withdrawals from my retirement account and I don't need that money, is it okay to go ahead and stick it in a CD? I said, you can do that. I said, but if you think about it, if you're pulling that money out of your retirement account and you're paying 12% to the federal government and 5% to the state of Missouri, that's 17% that could be still working for you in an investment that's now sitting in a bank CD. I said, so take what you want, take what you need, but let's not overtake and pay the government, because once we give it to the government, when do we get it back? Never. Right. So, and then last, sequence of return risk. In fact, it was so funny. You don't hear this much on the national network, but the other day this guy was on there and he said, we really got to watch this sequence of return risk. And what that basically means is none of us can control the stock market. Now, I know, Jeff, you think that you have a handle on
Oh, yeah,
this.
absolutely. On a daily basis, I'm sitting here manipulating the stock market. Sure. Yeah.
But basically, what it amounts to is we never know for sure, looking forward down the road a year, 5 years, 10 years, where we're going to be in an up market, a down market, a sideways market. And so having a plan as to how we're going to pull income, where we're going to pull income from, and how those investments may change in good and bad times, high interest rates, low interest rates, good stock markets, bad stock markets, and how do we protect ourselves, it's vitally important that we know that sequence of return is something that none of us can ever know.
So, Randy, when we talk about a plan of record, we're really not talking about just a mental picture or a spreadsheet. We're really talking about a measurable plan. What does a plan at Floyd Financial Group really look like? I mean, is it on paper? How does it work?
Yeah, so when people come in and we sit down, the first thing we're going to do is we're going to learn about them. We call that process discovery, and just learning about them and what's important to them and how they see retirement. From that point, we're going to learn a little bit about what they've saved, what Social Security looks like, if they have a pension, that sort of thing. Then from there, we're going to go into basically what we call the analysis part, and that is, let's look at what they've got, let's look at their risk tolerance, let's figure out coming up with a plan. And a plan is something that, yes, we start at some point, but the plan doesn't stay the same, and the plan is always changing. The investments in the plan are always changing, and they have to, because again, nothing is forever. So that plan, once it's established, and we talk to people about it, and it's not like, hey, here's the plan, it's our way or the highway. No, we talk to the client about it, explain to them why we're doing what we're doing and what the outcome could be and how it protects and how it grows their money. And then from there, we go into the implementation phase, which basically we help people implement that plan. And then from there, we basically just go into a monitoring and shifting and managing of that account as time goes forward.
What about the follow-up? How often should someone follow up with you or you follow up with them once the initial plan's made?
Yeah, everybody's a little different. If we have newer clients, a lot of times we're meeting every 90 days. For clients that have been with us a long time, generally 6 months, every 6 months, I have a formal sit down is what we look at. There are some people that we've had for 15, 20 years that know we're on the case. We're always watching. We're always managing because we have a fiduciary duty to do that. And we meet with them once a year, but we just kind of want to meet people wherever they are. Some people say, I don't want to think about this but twice a year. Some people say, I don't even want to think about it but once a year. Mm-hmm. They know that we're thinking about it daily, though. And so whatever people are comfortable with and what makes them feel good, we'll just meet them there.
So, Randy, I often invite people to call 417-889-7233 during the radio program, leave their name, telephone number, then Ashley calls them back and sets up that time for their casual conversation, their appointment, if you will. Can you elaborate a little bit on what that initial conversation is really like? As I said, it's not a formal thing. This really is just a casual conversation. You've called this before a no-tie zone, and you really get down to it. You told the story of the woman that you were talking with, or girl, and, you greeted her, and you had a little visiting, and then she said, well, I guess it's time to talk about the scary money stuff.
Yeah, we want to try to take the scary out of it. And one of the things we like to do here is really give people a little basic knowledge on, what we're doing and why we're doing it. Because once people understand a little bit more about why you do certain things and how things work. Now, here's the thing, we know what cause and effect is. We just don't know how deep the cause and effect will go each time, right? But we know that there's things that'll pull on the market, things that'll make the market go up, things that'll pull on interest rates, make interest rates go down, all of those things. But, when they come in and they sit down with us the first time, it's really just to get to know them and to understand what's important to them. And then we'll go about building a plan and making sure that they have enough insight and understanding of that plan to where they are comfortable with it. And then we meet with them along the way, doing this continual follow-up and monitoring of the plan as often as they like to do. Generally, most people don't want to come in here any more than every 90 days. And for the most part, I'd say probably every 6 months is what most people do in the end. But that very beginning meeting, it's very relaxed. We're going to drink coffee or a soft drink, whatever it is that you like, and just really sit back and just talk, get to know one another.
So, Randy, why is that so important to get to know someone? I mean, your grandma Maggard used to call it visiting. I mean, why do you just sit and visit with someone instead of saying, okay, let's get down to business. Let's talk about what you're here for.
So, a couple of things I would say about that. Number one, by doing that, we get to know them. But guess what else? They get to know us. And that's just as important, maybe even more important, that they know us and how we're going to be and react and respond in certain situations. So I think it's just really important that they get to know us. And, generally what ends up happening too is as people come on and become our clients, we get to know their families too. And so we become, if you will, kind of an extension of their family that's kind of out there. We're not intrusive and in their way, but we're always out there as that piece that many times they want to bounce ideas off of. They need extra money for a roof, for a new car. They want to pay for education, all those different things that come up.
So, Randy, once we start with the discovery process, as you said, we get into the analysis, the planning, the implementation, and then finally we go to the follow-up. That's sort of our 5-step process here at Floyd Financial Group. How long of a process is that from discovery all the way to follow-up? It's not just really one meeting or 2 meetings, is it?
Yeah, it just depends on the client. Generally speaking, it's 2 to 3 meetings, I would say, is what generally is there. Now, I've had it where it was 6 meetings. Again, we'll just kind of meet people where they are. So there's no hard line cookie cutter stamp here. It's just we're going to meet people where they are.
Okay, and Randy, when you say we meet people where they are, what does that really mean?
Basically, it just means we want to help people to feel comfortable with what we're going to be doing with their money if they select us to help them with their money. I mean, that's really about as simple as I can get it.
Right. Well, everyone puts their pants on the same way, one leg at a time. I know Grandma Maggard has said, and we've referred to Grandma Maggard many times in this radio program over the years. But really, I think there's a lot of people who listen to the program and they say, well, these guys are really, really smart. They must be just for rich people here in the Springfield area. But I think meeting people where they are is really just, not passing judgment on people. Are there minimums or minimum amounts that really you work with at Floyd Financial Group?
No, there's really no minimum that we work with here at Floyd Financial Group. In fact, I would say, people say, well, some people don't want to do it for less than, I think it was Fisher Investments used to be $500,000. Now they want $1 million.
Yeah. Right.
So, I would say this, if you've worked a lifetime and, you've got 100,000 or 150,000 or whatever that number is, or you've got $1 million, the 150,000 is just as important and maybe more important than the person that has 5 million. So we want to meet people where they are and help them the best that we can from where they are and where their life has taken them.
All right. So if people are listening to the program right now, they are intrigued about this process. and they want to get started with it, how can they go ahead and do that? How can we begin this conversation?
All they need to do is just reach out to Floyd Financial Group here at 889-7233. Of course, that's 417-889-7233. Or you can go online at floydfinancialgroup.com and request. Either way is fine with us, but if you call the office, Ashley will be there to greet you and set up, a meeting at your convenience. If for some reason we don't have these big automated voice machines, we do take voicemail out there if we are all tied up, but Ashley will call you back in a timely fashion and get you scheduled.
And I want people to understand, too, Randy and Jake, you guys are really just like the people that you serve, right?
Absolutely. As my grandma always said, there's no big I's and little U's. We're all the same.
All right. So people want to deal with someone who understands them, the way of life here in Springfield, and understands what's important to them. Call us here at Floyd Financial Group. We'd love to help you out. Get your no-cost, no-obligation Floyd Financial Group Retirement Review. We would love to talk to you. 417-889-7233, and is always online at floydfinancialgroup.com. Well, Randy and Jake, we're out of time for this week. Thank you so much for your time, but most importantly, I want to thank the greatest listeners in the world, ours right here in the greater Springfield area. So for Randy and Jake Floyd, I'm Jeff Shade, wishing you a great fall weekend. We'll talk to you again next week right here with another edition of Show Me the Money on 104.1 FM KSGF, where Springfield comes to talk. The information provided in the preceding program is for educational purposes only and is not intended as investment advice for any individual or entity. All information contained herein is believed to be from reliable sources. However, we make no representations as to its completeness or accuracy. The opinions expressed are subject to change without notice and do not constitute financial, legal, or tax advice. Please consult your financial professional before executing any financial strategy. Financial planning is offered through Floyd Financial Group, LLC, an SEC registered investment advisor.